charts and technical analysis as far as the equities market is concerned. Let's bring in Robert Omotunde, who is the head of investment research at Afrinvest. Good morning.
Morning, boss.
Thanks for coming.
Thank you.
And we have a lot of conversation. Very interesting time at the market, isn't it?
Yeah, true. It's very interesting for the market.
Very interesting for the market. Let's have this conversation with you, and of course, with some of the charts that you also threw in. Let's start with the conversation. Most of last year was foreign investors. What is changing? Is anything changing? Let's throw this chart on the screen and see what is changing from what you folks, your team, just threw at us, and it's now on the screen.
Okay, so what we've basically analyzed is that in 2014, when we started seeing the fall in global oil prices, at some point in 2014, FPI inflow into equities market peaked at $4.8 billion. By 2015, sometime around 2015, we saw the FPI figure declining to as low as 1.5 billion. And by first quarter of 2017, it was 107 million. You know, it was a monumental fall that we saw, you know, in FPI inflow. So what has changed? What changed basically was the introduction of I&E window, which was announced by the central bank on April 21st. Between April 21st and now, market has traded 35 times, you know, and has lost only 5 times. So basically, market has been pretty hot. And the basic thing is because investors see this I&E window as much more reflective of market conditions. So we are going to see more of that. We have said that market is on for a long-term bull run.
Very interesting. Part of it, if you look at the right side, or sorry, the left side, the second column of the change in tide, page 1 of what you sent in, and it said foreign investments in the equities are about $4.9 billion in 2013. But you see this coming back. Again, if you look at the chart there, and I'm sure you can see that, Robert, you said, if you look at the Eurozone crisis weighing on sentiments in 2011, if you go to the far right of the chart, and you can see, we can see the dip in FPI, foreign portfolio investors. For folks who are looking at it, that's a very sharp arrow around the second to the last peak there. And of course, we saw the bottom where the charts, the pillars seem to go into almost an oblivion, and again, but of course we've seen that rally now towards the extreme end, and it says a rally driven by perceived adoption of flexible FX regime. This is a window that has added about $2 billion since April 21st.
Yep, true. So what you will see basically in the chart is that we're trying to show how much FPI is driving the performance of Nigerian equities, right? Yes, you read from 2011 when we had the Eurozone crisis. In fact, we could say that after the global financial crisis of 2008-2009, we've seen that foreign investors are the major drivers of Nigerian equities.
And that was 2012, 2013.
2012, 2013, 2014. These are the periods we've termed the period of normal foreign exchange management, you know. I mean, between 20...
Currency peg.
Yeah. No. More something more reflective of market between 2011 and, say, 2014. It was between 2014 and 2016, you know, and, of course, we had a change in tide in 2017 that we started seeing a lot of demand management controls, you know, and a lot of manipulation, in quotes, of the foreign exchange market. But we are beginning to see a much more improved transparency in terms of how the foreign exchange is allocated, you know, within the system. And this has significantly improved the performance of equities. Nothing
good lasts forever. So if you look at where we are right now, what are the greatest risks? And you said this is liquidity and the market structure. Do you think there's a little bit of something here, risks that should be considered? And we're going to throw that to the screen right now to try and get a sense of this chart for you to explain.
Yes. So what we are saying is that the market is, you know, remember that in 2015 and 2016, we saw a sort of resilient performance by most of the companies. These were not priced into the the pricing of these stocks, even though their fundamentals were resilient, the banks were booking, you know, very impressive numbers. You know, the likes of GT posted above $100 billion. Naira, despite the fact that the economy was in recession, right? So what we are saying now is that with the flexibility that has sort of returned into the foreign exchange market, we are seeing investors trying to catch up, you know, with the pricing, which has not been, you know, considered before now. And that is why we have termed this period the period of great macro trade, you know, because we believe that it is macroeconomic factors, basically foreign exchange market, that is driving the current rally that we're experiencing.
If liquidity and the market structure is going to be greatest risk, how do you think this risk can be mitigated? What do you think should hold on to prevent this market from sinking?
Okay, so what we've analyzed is that foreign exchange administration currently is the greatest risk, you know, because it is the risk to the upside that is currently driving the market. So if there's going to be a change in tide, it's possibly, if there is anything that will significantly alter the pricing of the foreign exchange market, you know, which the CBN has shown a lot of commitment to ensuring that there is a change in the story of Nigeria in terms of how foreign exchange is priced. So, but we believe that if there is anything that will change or that will constitute a major risk, you know, to the current optimism we are seeing in the market, if there is any fundamental shift in terms of how foreign exchange is priced. For instance, if the CBN decides to introduce another peg, which of course could be as a result of any shock, you know, within the economy, if there is a fall in global oil prices or there is a significant drop in domestic production. But again, we have always advocated, remember, I was in this studio and a lot of my colleagues several times in 2015 and 2016 trying to preach that flexibility in foreign exchange management is the best way for the economy to grow. You know, I mean, everybody smiles, right? And this is an example of what you get when your market is flexible.
Well, when the market is good, I smile here in the studios.
Correct.
You folks are the ones making the money and doing the analysis. But let's look at some of the pricing in some of the sectors that you try to push out. I will throw this out for our viewers on the screen. Industrials, oil and gas, and the banking sector, consumer goods. And these are the four sectors. Last week was massive to the north for the oil and gas folks in the market. If you put that in there, and I'm trying to read out what you said, what your analysis reveals, that the banking, industrial, oil and gas, and consumer consumer stocks are underpriced when compared to other sub-Saharan African frontier markets. Take us through what you call this sectoral scenario.
Okay, so since the bullish run started, you know, on April 21st, a number of sectors have benefited immensely, you know, and most of them you can attribute to the fact that consumer goods, banking, and the industrial goods sectors, and even oil and gas are significantly skewed towards the MSCI Frontier Index, you know. So, and we've seen the pricing across sectors for consumer goods, for banking, for industrial goods, and the oil and gas. And we've seen that even though the market has reached the 33,000 points, you know, as at Friday, these stocks still look, I mean, these sectors still look significantly underpriced when you compare them to their peers in the frontier market, you know. And the frontier market I'm referring to are those other countries that make up the MSCI Frontier Index.
Let's throw that back on the screen. Let's throw that back to the screen. If you look at the industrial goods sector, you're looking at Nigeria, Kenya, Mauritius, and Vietnam. Those are folks who are in the same region together. That's for folks. That's the table. In yellow, to the top right is the banking sector. If you look at the price in the 66.5 multiples for the banking sectors, for the banking sectors in the Vietnamese market, Nigeria will do 6.5. In fact, those folks in Vietnam beat the rest of Africa. Technically speaking, Mauritius and Kenya are outside South Africa. Then we look at the industrial goods and the oil and gas. The pictures are very there: the yellow, the blue, the green, and the orange.
So it means that with the exception of, from what you've highlighted, with the exception of the consumer goods sector, the industrial goods, the banking sector, and of course the oil and gas are still up for significant upside if you are to compare them with their peers in the same frontier market index, you know. And that's the story we are trying to preach here. The fact that yes, market is up there, but you can go further up, you know, which is why we're saying that if you have to compare it with comparable countries that are also in the frontier, I mean the MSCI Frontier Index, then we should be talking about markets still gaining some more point, except for the consumer goods sector, which is obviously overpriced in Nigeria, of course, because their earnings, most of their earnings have been pressured. They suffered the most from the FX controls.
And the 41 items.
Yeah, and I mean the 41 items, a lot of them, were beaten.
So for consumer goods, you think they are historically a little bit expensive right now?
They're a little bit expensive
Nestle
now.
Nestle is about 1,000 naira.
Correct. But again, that's what I'm saying, that if you compare with other markets, as we speak, Nigerian consumer goods are overpriced. And I explained, it's about price to earnings. So their earnings have been down significantly, but they are recovering, so we may begin to see some downward repricing of the valuation, even if prices remain the same, because they're going to see improved earnings as we go along.
Let us take the final chart that you have is the movement of the Nigerian All Share Index against 14 days. Okay, that is there. That looks like one of the most crazy charts that you put out there. Really crazy. And if you look at the I'm trying to get it there from a very clean one. Okay, then the blue line is the NSE All Share Index. That's the composite index for the Nigerian Stock Exchange. Look a little bit wacky over 2011 a period. If I trace that and you see the surge in the year to 2013 in the blue line, all the way picking up 2014 and giving me a bit of a nosedive all the way running down the 20,000 level before the recent peak around 20 to 30,000.
So what we're saying here,
relate that to the 14-day RSI.
Okay, so what we're saying here is that analysts and technical traders generally, we track the movement of the relative strength index, to see when market is overpriced or when it is when it's overbought or when it's oversold, right? And the story we're trying to say here is that we've seen 2 years period, like a 2-year period when market was more or less stagnant. So technical analysis would not have worked if you're trying to price Nigeria 2 years ago. But now market is repricing and retracing its steps. So before we begin to apply technicals, if you see, if market does above 70 point RSI, we should begin to see a correction. But market has not corrected. We've seen sustained rally, even though market is within the overbought region.
So you think we still have more room to grow here? We have more room to grow here. Thank you. Thank you. I wish we have more room and more time to have this. But we'll get you back. You folks back in the next couple of days. Robert Omotunde, teeing off today's trading day and the week for us with those technical analyses around the Nigerian market.